Good morning, everyone, and great to have everyone here in our session today. And this is a 1-hour session to help you improve your knowledge and understanding in one of the key areas, that is consolidated accounts. And we've got with us Sandy Hood, all the way from the UK. Sandy, good morning to you. Great to have you here.
Good morning, everybody. Good morning, Andrew.
All right. Now, today is the 18th of March, 2017. This is our class number 1. And we got some exciting classes planned for the next months ahead as well. And we are going to talk about group accounts. And I must say, Sandy, this used to be one of the difficult areas for me when I used to study. So in this case, you're going to be my teacher, as usual, and I'm going to be your student, and both of us will go through this interesting case study. Over to you.
Well, I think that sounds super.
Over to you. And I'm going to make you the presenter, and you will be sharing your screen with us.
That's good.
Correct.
Okay,
great.
And yes, so we've got a picture of a lock, a picture of a river, and a picture of a stream. The question that we're going to look at is called Lock, River and Stream. And I was going to say to you, when you tackle a question, and do you tend to sort of read through the question and then see what the task requirements are, or do you tend to look at the task requirements first and then move on to see the detail in the question?
Oh, that's a difficult question, actually. I'm going to put it out to the others who are there. We've got a number of people attending. So, guys, please help me out. What do you think? When you see a question like this, do you go into the tasks first, or do you read the scenario? What do you do first? Do you look at the task, or do you look at the scenario? What do you guys think? Well, I'm expecting some answers from our attendees today. So let us see what people say. Let us see. Oh, well, very good, Koshed. He's saying tasks. So I can see a lot of people saying tasks, right, Sandy? So I will go for that. I will look at the task first. What do you think?
I agree with you. I think sometimes when you're in an exam, time is very important. So I would recommend looking at the task. I think it helps you to focus on what you're looking for when you read the question. Here our task says, Part A for 3 marks, prepare a journal entry. Part B for 22 marks, produce a consolidated, well, in those days it was called a statement of comprehensive income. Now we call it a statement of profit and loss, and a consolidated statement of financial position. So we know now what we're looking for as we go through the data that's been provided. Now here we start with the statements of financial position for these 3 different companies. We don't know the level of consolidation required yet, but we can certainly see the detail on each of their individual company accounts. And looking at Lock has made a loan to River and owns 156,000 ordinary shares of Stream, which gives me a bit of a clue that Lock's probably the parent company. Exactly what proportion of subsidiary the other companies are is not clear yet. We can then see that the inventory, we can see on the current assets, this question has been quite gentle, because it specifies that Lock has got a current account with River. You wouldn't always get that. Sometimes that would be incorporated within trade receivables and you then have to work it out. But that it's been done quite nicely in this particular case.
Examiner has been kind.
The examiner has been very kind. And in the equity and liabilities, all the shares are at $1 each, which can save a lot of worries, because sometimes in the exam, if you've got different share prices in terms of their nominal value, then it's another thing you have to try and remember. So it's quite nice, again, to see the equity shares all have a nominal value of $1 each. Retained earnings shown, a loan from Lock. So here we've got the 300 in the River column, and looking back up to the top, we can see loan to River in the Lock column. So that looks as if it's going to be an intercompany loan. And further down, we've got the current liabilities, and the final one, another act of generosity by the examiner, current account with Lock, showing that River, consider that they owe Lock $75,000. Interesting. Lock thinks that River owe them $101,000. So a slight difference there, and we want to sort of make a mental note of that if nothing else. Here, a little bit easier to read, particularly if you've got a small screen. We've got some very simple profit and loss accounts, and we can see here Lock, River and Stream shown with their various profits for the year. And then we enter the additional information. Additional information, inevitable if you're going to get a consolidation question. So Lock holds shares in two other entities. I think we pretty much guessed that. Lock acquired all of River's equity shares on the 1st of April 2011 in a share-for-share exchange. Now, immediately I'm thinking, oh, when was it that these accounts were? Well, these accounts on the previous slide are for the 31st of March 2012. So we've only held those shares for a year. The purchase consideration, $950,000, on the 1st of April, the shares at a market value of $2. Okay? So that's a market share price, not the $1 nominal share price. River's retained earnings, good, that's going to be information that we're going to use later. And Lock had advanced a loan, I think we'd spotted that. A fair value of River's property, so here, bringing in one of those consolidation concepts, that the group accounts do not necessarily reflect property, plant and equipment at the same value as the company's own accounts. So here we've got a fair value excess of $144,000, and this was attributed to buildings that are owned by River. So Lock had gone along, bought the company, and then said, in your accounts it says they're worth one figure, we think they're worth £144,000 more than that.
That's great, isn't it?
And at the date,
That's great.
That is it. Let me ask you a question. Are fair value adjustments always going to be higher than the value in the company's books?
What do you think, guys? So I have a lot of friends out there, so I'm going to put the question to all my friends out there to find out the answer. So Ivana says no. What about the others? I know we've got a number of people there. So the question is, Sandy, what is the question again?
Here we've got an example of a fair value adjustment which effectively increases the value of River to the group compared with the company's own accounts.
Yes.
Is a fair value adjustment always going to increase the value of the subsidiary?
Well, I've got a lot of people saying no.
They're very clever.
Wow.
You've got the best people.
Good friends. Good to have them around. So, I'm sure I'm going to win this session.
You're doing very, very well. Yes, of course. And one example could be that if there's a liability, if the company has got a contingent liability, perhaps a member of staff has been injured at work and there's a court case that's imminent, and the company's accounts might say, oh, well, we think that this is a possible cost, so we've included it at $3 million, when as the taking over company, we think the fair value is actually $5 million,
right.
Then that will reduce the value of the net assets of, in this case, River.
Right. Very important point, everyone. Yeah.
Here we've got a bit of news that presumably has only just taken place, because we are going to be consolidating on the 31st of March, and there's been an impairment in the goodwill of River. So we need to make a note of that in a few minutes. And Lock has purchased its shareholding in Stream on the 1st of April. So both of these acquisitions have taken place on the 1st of April. Business must have been very, very busy. And they paid $223,000. And we're told what the retained earnings were at the time. And the fair value of the Stream's net assets was the same. So there's no fair value adjustment. Now, we come across an expression here. Lock exercises significant influence over all aspects of Stream's financial and operating policies. Andrew, do you know by any chance what this means as far as we're concerned in the accounts when we consolidate? What does it mean to us that Lock has got significant influence over the financial and operating policies of Stream?
So again, I'm going to my team because they've been answering all the questions correctly. So what do you guys think? What do you guys think? I can see a lot of answers coming through. So what do you mean by significant control? What does that mean? What does that mean? A majority shareholding. Akbar says majority shareholding. What about the others? Yes, I'm waiting for the others to answer. Influence the decision of the company.
They certainly can. They're going to have a very significant influence over the decisions that the company makes.
Controlling shareholders. There you go. Controlling shareholders.
Right. I'm going to help you with this one.
Right.
I'm not going to give you the point. I'm awfully sorry, Andrew. But this is an example of an associate. And I think this is quite important. And I think just as important as the words that it says, significant influence, the word that it doesn't say is control.
Right.
So here, Lock does not have control over Stream, and as such, Stream will not be a subsidiary. Lock has significant influence, which means that the activities of Stream are likely to be, in many ways, carried out to the benefit of Lock, but they don't have control. So when we come to the consolidation, we will treat Stream as an associate company. We won't treat Stream as a subsidiary company.
Right, so that's the big difference, isn't it?
Yes, yeah, very big difference. And there are two different accounting techniques that are used.
Right.
The subsidiary company is consolidated, whereas we use equity accounting when we deal with an associate company.
Okay, thank you.
But well done so far, well done so far. Lock occasionally trades with River, and so River we've identified from the earlier slide is a company that we own 100% of. So during September 2011, so that's quite a long time ago, Lock sold River goods for 220,000. And Lock uses a markup on costs of 50%. And at the 31st of March, all the goods remained in River's closing inventory. Well, there's a little question here about why on earth did they buy them in September and still have them in March. But that's not something for us to address. What we've got here is quite a fundamental aspect of consolidation. When we consolidate the accounts, we effectively produce a single set of accounts for all the companies. Now, if River and Lock were divisions of the same company, then there wouldn't be any internal profit being reported on goods that hadn't been sold yet. So this has to be dealt with in order that we take out any unrealized profit as we later work our way through. Now, who can remember? I had a bit of a question mark earlier on when we were looking at the money that Lock thought that River owed it and the money that River thought it owed Lock. Can anyone remember how much we thought Lock thought that it was owed by River? It's a tricky one.
Yes, it is a tricky one.
If you can remember it, then put it in the chat box.
Oh, I've got one person saying 300,000 and 101.
The 101 one is the correct one. Well done.
101.
Well
yes, a lot of people saying 101. Very good.
Oh, well done. Very, very good. And can you remember how much River thinks it owes Lock?
75. Very good.
Now, I have an idea that we've got some people who are good at takeaway songs. So, what's the difference between 101,000 and 75,000?
The markup, they say.
It wouldn't be the markup on this occasion. It's 26,000
cash in transit. Another answer.
That is our good. River has posted a check to Lock for 26,000. So if you're doing the accounts at River, you've already debited the account with 26,000 and sent off the check for 26,000. So the accounts are showing 75,000 because you've already paid 26. But the 26 hasn't been put into the accounts at Lock because it hasn't arrived yet. Checks in the post. So that's that 26,000, which gives us an opportunity to go, oh, that's not a problem for us. We'll be able to deal with that later.
Yes, that's good. Anish, right. Very good.
Excellent. And at the 31st of March, loan interest was due and had not been paid. So we've got some loan interest due by River, and so they had accrued it within their accounts, but Lock hasn't made an entry for that as part of interest income. So we will come across that as we work on it. But the fact that we know what we're looking for has helped us enormously, that we haven't had to go through it and think, what are we looking for? We've known what we're looking for because we read the question first. Did you find that reading the task first helped you to focus?
What do you guys think? Did it help you? Yes. People are saying it is very helpful.
And certainly they told us in advance that this is what they do normally, which is marvellous.
Correct, yes.
So let's look at prepare the journal entries to record the purchase of River in Lock's accounting records. Lock acquired all of the River's equity shares, so this is 100% owned and controlled subsidiary on the 1st of April in the share-for-share exchange, and they agreed the purchase consideration of 950,000, but they've not recorded them in their accounting records. So we've had a couple of examples of this. They didn't record the interest either, did they? And on the 1st of April, Lock shares had a market value. So Lock is a quoted company with shares which are being bought and sold on a daily basis at $2 each. River's retained earnings were 130,000. Okay. So let's see which to focus on. They've not yet recorded the acquisition in the accounting records. I was going to ask you this one, but here we go. Each share has a market value of $2, and the total consideration that they paid was worth 950,000. They didn't give them money, they gave them shares. So they would have issued 475,000 shares.
So, Sunday, there's a difference between that nominal value and the market value, isn't it? So, I want to ask...
There is.
Yeah, so there is a particular name for that, isn't it? That type of, there's a difference. So, guys, can you help me? I've forgotten what this name is all about. There is a particular name. What do you call that? So there is an... Oh, people are very smart. I'm getting answers very quickly. Share premium. Yes, very good. We've got a smart lot of people here. So share premium. There you go.
So we've got a share premium, and we're going to have more equity shares. So here we've got these 475,000 shares issued, and the equity shares in Lock have gone up by 475,000, and as you quite rightly said, we've got a new account. We didn't have a share premium account on the original set of accounts, but now we will have, and that will be for 475,000, the premium over and above the nominal value of the shares that were issued. Oh, we've got some very clever people with us today. Excellent. You know, I've put a sort of snapshot of the account for Lock so we can see where it fits in. So that's three marks. Hopefully you consider, oh, that's quite easy. 3 marks. In an exam, what we'll be looking at about 5.4 minutes. But you've got to be recognise that within a big question like this, there's an element of a chunk of time being used at the beginning to come to terms with the question. So the next question is for 22 marks, and we have a structure here. When you're in your exam hall, you should open up the answer booklet and draw up a structure for each statement. Now, there are 2 statements here. I will rewrite the first one as being prepare the consolidated profit or loss account for Lock for the year ending the 31st of March, and a consolidated statement of financial position for Lock as at the 31st of March, in accordance with the requirements of the IFRS. So having drawn up those 2 structures, we would then draw up a series of workings. So I've done this. At this stage, I haven't necessarily recognised that Stream is a associate company, so I've got that as one of my column headings. And then I've written down the side. Now, down the side I think is quite important. On the left you can see pretty much the same row headings as we saw on the accounts for the individual companies. Revenue, cost of sales. Then we've got 2 spare rows underneath the cost of sales. That's because we're likely to have some additional figures to go into any consolidated statement of profit or loss. So the cost of sales needs more space. Then the gross profit, which we will work out. Then we've got expenses, because that's how then we describe in the accounts of the individual companies. I've kept a spare row because we might get some additional items in there. We will then work out the profit from operations. I've got a couple of extra spare rows, and then finance cost, profit before tax, tax and profit for the year. I've got my structure, and I've done something very similar with the statement of financial position. My apologies for those of you trying to look at this on a very small screen. The words can be quite small, but the only row that I've added is the row for goodwill, because we know implicitly that if this is a consolidated statement of financial position, that there will be goodwill at some point that we will have had to have calculated. Quite a few little spare rows. An element underneath the equity section called non-controlling interest, and then we're working our way down to total equity and liabilities. So we've got our structures in, and sometimes in an exam, in the intensity of the exam, it's quite nice to just write out your accounts, because it gives you a moment when you're doing something which is very routine for those heavy-duty thinking cells at the back of your brain to have a little bit of a rest before you really put them to work. We also have 5 key workings. One of the workings is identifying the group structure. Then we've got something on the net assets of a subsidiary. Then we would work out the goodwill. We've got another working for non-controlling interest and one for retained earnings.
Sandy, I've got a question for you.
Oh, sorry, yes. I've seen the pup for the first time. He looks gorgeous. Yes, fire away.
Right, so this means for consolidated accounts, what you say is have those, the workings, just mark them as, these are the workings that you have to be doing at, for your sum. And that way you'll not forget to do these workings, isn't it?
Absolutely. And in an exam, you're typically given an A4 size booklet. And so I would normally expect you to open up the booklet, go onto a double page, have one side for your statement of profit or loss, and the other one for your consolidated statement of financial position. And then on the third page, I would just be doing those headings: group structure, net assets table, goodwill, non-controlling interest. Maybe onto the next page, retained earnings. And then these other ones. We're going to have a provision for unrealised profit, some intercompany trading, and investment in associates. And the questions, certainly as you scale up in terms of complexity, you can have more and more workings that would go with a particular question. But yes, get these workings in quickly, and what we're going to do is we're going to work through the workings. We're going to collect information from the data given in the question and use it to fill in the workings as we go from one to another.
Just to remind you, Sandy, we've got a few minutes even for the exam question, so you'll have to hurry up with your workings, isn't it? It's just maybe 20 minutes we've got now. So you will see, everyone, how Sandy will quickly work through these workings and finish it off as he talks. A challenge, Sandy, I've set.
And when we get to the end, you'll see why the workings are so important, because we'll look at the mark scheme. So here we've got the information, and we're going to read through the narrative, and we can see from here what's going on. So Locke holds shares in 2 other entities. Fine. Locke acquired all of the Rivers equity shares. So we've done that calculation. Then we've got the loan that's been advanced. And so we can start to take this information. First of all, the group structure. Let's get the group structure and draw that up. Then we'll also look at the net assets of River. And we'll also look at the goodwill that's been calculated. We're not going to be completing these workings. we're going to be slotting numbers in. Then we'll look at the statement of financial position, and because it's internal, we can eliminate this loan. So we will take the asset out of Lock, and we'll take the liability out of River. Then the fair value of the excess, that will also go into the net assets table in relation to River. So here we see the group structure. Lock's got 100% of River. They've held it for a year, and so we've put that onto our first working. We've done nothing with Stream. We know that Stream exists. But we're working down that list in that way that a good stock taker works through a stockroom, taking each item one by one and not missing anything out. And that can be so important in an exam. We've taken the 130,000 retained earnings at acquisition and put that into our net assets table. We've taken the 950,000 consideration and put that into our goodwill table. And we've recognised that this is a 100% acquisition. So when it's 100%, we have no controlling interest, no non-controlling interest. Then we've eliminated the 2 300s. The intercompany loan has gone. And we now come back and we do a bit more on the net assets table because we're working our way down the list. We've got the fair value adjustment. The fair value of that building was 144,000 more than it was when we in the valuation within River's own accounts. And a year on, because we acquired it on the 1st of April 2011, it's now had one more year for wear and tear. So we are depreciating it by 1/12 because it's been identified as having a 12-year life. And we're able to put that depreciation into our consolidated statement of profit or loss. It's in all probability, this building would constitute part of cost of sales because it's probably where the manufacturing is taking place. It could be different in a way. There's an element of room for manoeuvre within this, but I would tend to stick with cost of sales. And now we look, and we can see what we've done. We've taken all of that information and we've put it in. And we haven't missed anything out because we just worked down the list. And we do the same again with the next list. Lock carried out an impairment review. That requires us to put the impairment value into the goodwill workings. This isn't complete. It's simply making sure that we don't miss anything else. And the impairment goes through as an expense, so that's fine as well. Then we look at the purchase of the shareholding, and we can see that we're going to have to make an adjustment to the group structure, and that we're going to use our working, which is based on the investment in the associates. So 156,000 ordinary shares out of 520, well, that fits in with the significant influence. We've got less than 50% of the shares. We know the 520 is 520,000 shares because each of them is worth a nominal $1 each. And we've eliminated the $15 for the loan payable because it's an internal transaction within the company. And there's the other 15 gone. There's a 15 being taken off the finance cost of River. So not only do they not owe it, it's not in there as one of their expenses. It's all about. So here goes we can see the working now. Lock's got 30% of Stream and they've had it for 1 year. Now looking at the consideration of 223,000 for Stream and the retained earnings at acquisition. Now I've put this in as a minus figure. Can anybody like to think why retained earnings at acquisition might be a minus figure as far as an investment in associates is concerned. It's going to go into a later calculator.
So anyone, can you give us the answer, please? Because we want to find out why we've got a minus figure as retained earnings at acquisition. Needs to be eliminated as this belongs to the previous owner.
Perfect.
Anish,
So
fantastic. You've been doing great studies.
Very, very well done. Now we're moving on with a provision for unrealised profit for that sale. I think that you'll like this layout. Oh, the puppy's changed. And so we've got the sales revenue of 220,000. Fair enough. We thought it was a bit odd that they would sell something in September and it still remain in their storeroom, but that's what the question says. We've got to make sure that you understand the difference in market and margin. Here, it's the profit is on the cost. So we've got a 50% profit on the cost, meaning that the selling price is 150% of whatever the cost is. So here, we've been able to work out that the closing inventory is the same as the sales value. Therefore, 50 over 150 of the value of the sales is a profit that Locke has made by selling to River. But because it hasn't gone outside the group, it's an unrealised profit, and we will then have to adjust for that as we consolidate it. So if the inventory was sold by the parent, we deduct the value from retained earnings. If it was sold by the subsidiary, then we deduct it from the net assets of the subsidiary. And here Locke is the parent, and the entries required are the closing inventory value must be reduced, and the retained earnings must also be reduced. So here we've got the retained earnings with a minus figure, so that when we look at the profitability of Locke, it includes that 73, so it has to be taken out. And I put it in here. I know for some of you it's very small, but there's a minus 73 on the inventory line. And of course, as we work out the gross profit, then we are also having to include that 73 within the cost of sales within River. Right, here we've got the intercompany transaction. River posted a cheque to Locke for 26,000, which did not arrive until April. So we're going to be doing a working on the intercompany transactions. And here it is. We've got a cheque in the post, 26,000 coming out, 26,000 adding to cash. Absolutely. And then eliminate Rivers. Oh yeah, here we've got the 15,000 loan interest. And here it is. The interest has come off, the 15,000 here, and the 15,000 has come off here, leaving us with 25,000 owing. Now, we consolidate River as a subsidiary, but add a line to show the associate. So the associate only appears as one line in both the statement of profit or loss and in the statement of financial position. So I've copied the numbers in, and over here you can see I've got a minus 220 because that reflects the intercompany sale, and I've got a 220 added on because the cost of sales of River has had 220 reduced from it, and always a minus number, so we are reducing the cost of sales by 220. And we've recognised the pub, the 73,000 value that was in the closing inventory, and we've also recognised the depreciation of the fair value adjustment. here we've copied in the expenses, and we've got the other 20 in here, which is the it's just slipped out of my head, but I will remember in a minute. And then we've got the finance costs that we add together, and then the tax also. And similarly, we've got the entries in the consolidated statement of financial position. We're beginning to put them in. And what I've done, which would help you if you've got a big screen, is you can see on the top left-hand side, almost the size of a stamp, is the information from the question, because this is how you'd be transferring it within the exam. You'd be writing them across. Again, it's a moment during the exam where you're able to allow your thinking cells to sort of just have a little bit of rest as you do a more routine task. Now here's my intercompany transactions. Oh, I thought I'd changed this actually. Right, okay. But you topped up each of the columns. And now we go back and we complete the workings. So we've got our completed workings 1, and we've got our completed workings 2, which is useful. We've now got the value of the equity shares at the reporting date, because we've taken it from the statement of financial position. We've got the value of the retained earnings at the reporting date, because we've taken it from the statement of financial position. We've added back the interest that was eliminated. So within the reported profit of River, there'd been 15 deducted for interest payable to Lock, while if we're eliminating intercompany transactions, that then goes. We've added 144 for the fair value adjustment to the buildings, and we've deducted 1 year of depreciation. So we've got a reporting date value of 1,132. And here's a question that many students ask me is, how do we know the value of the equity shares at acquisition? The answer to that is, unless you're told to the contrary, you should assume that the equity share value at acquisition is the same at the reporting date. If you told something different, that there'd been a share issue during the period, that would be fine. You'd be able to calculate it by identifying what the share issue was. But almost always you can copy it back from the reporting date. So now we've got 2 columns. We know the value at acquisition of River was 600 for the equity shares, 130 for the retained earnings, and we've added on the fair value adjustment of 144. So that gives me a net assets at acquisition of 874. We're going to use that information to work out the goodwill, and later on we're going to look at the difference between these 2 net asset values to see how the profit has been increased during the period of Lock's ownership of River. So here we've got the goodwill calculation. We'd already put in the 950 and we'd already put in the minus 20. There's no non-controlling interest. The net assets acquisition we've taken from workings number 2. So 950 minus 874 gives us the goodwill at acquisition. So on the 1st of April 2011, the goodwill that we had in River was 76. We've since impaired that, and it's now 56.
So Sandy, I've got a question for you. So where does this 56 go? It needs a home.
On the current slide,
yes,
right up at the top, we've got goodwill.
Right.
And that's going to go into the consolidated statement of financial position at the 31st of March, 56 for goodwill. Can you?
Yes.
Have I got my little arrow?
Yes.
Okay, that's
Thank
marvelous.
you.
So that's a intangible, non-current asset, and certainly, I'm sure the class will know that we have special treatments for intangible assets within the International Accounting Standards. There's no non-controlling interest, so although I was telling us that we had to have a workings for, in this particular case we don't. And I've always said to students, have a workings for and just leave it blank, rather than chop and change. I think it's helpful if you're doing lots and lots of questions, just to know that every time you do a question, workings for is always going to be non-controlling interest. Workings 5, retained earnings. I'm taking information now. I've got the 413 retained earnings of Lock. Great, but I don't know what my post-acquisition share of the retained earnings at River is just yet. We'll have a look at workings 2, but we haven't got it. We know that there was an impairment, there was an impairment of the investment in River, and that was 20, so that's a minus 20. And we will have a look at Stream, but that's not ready yet. So we're beginning to build up our retained earnings working.
So I have another question for our team, because I'm not sure how it works. Does the impairment of goodwill of a subsidiary always reduce the group retained earnings? What do you think, guys? So let's see what the team says. Does the impairment of goodwill of a subsidiary always reduce the group's retained earnings? What do you think? A yes or a no? So we're getting some answers. People are saying yes. Yeah. Majority are saying yes.
Well done. It does, but it doesn't always reduce it entirely. In certain situations, when you've got a subsidiary that you've taken over where there is a non-controlling interest, so imagine that we'd only taken 80% of River.
Okay.
Then there are two different treatments for that. Either we treat the value of the non-controlling interest as a proportion of the value of the net assets, or we treat it as what we call fair value. And if we've got a fair value subsidiary and there is an impairment, then the impairment is shared between the retained earnings of the group and the non-controlling interest.
Right.
So in those situations, you would have a impairment deduction from the non-controlling interest, but there would still be a deduction, but it just wouldn't be 100% deduction from the retained earnings of the group.
Right. Okay.
Good question.
Yes.
Good question. Here we've got the investment in associates, and it shows the value of the consideration. We've added on the retained earnings at the reporting date, which you very, very rightly identified as being quite important, and so that we are only interested in the post-acquisition increase in the retained earnings. So we deducted that 45, we have 80, and because Lock holds 30%, then Lock is entitled to 30% of the post-acquisition increase in the reserves. So that's 24, so that gives us a value of the investment at the reporting date. So we've got two different bits of information on here that we will use in a few minutes. The 24 post-acquisition increase in the profits of Stream is going to be added to our statement of profit or loss, and the value of the investment at the reporting date is going to be included within our statement of financial position. So in goes 247. What I've done here is I've added an extra column just so that it's easier to read the numbers right up against the line. So 247, where my white arrow is investment in associate. I showed the intercompany transactions example earlier, but this is a far better example because now we've got everything in there. Everything is in, and we can see how all the numbers along the bottom under the black line show us the values that are going to go into our statement of financial position. So the inventory, we're adding together the parent Lock, the subsidiary River, we're deducting the pub, and that's going to be our inventory figure going straight into the statement of financial position. Then we've got trade receivables. I said earlier that the examiner had been quite nice in having current accounts shown as separate items within the current assets and within the current liabilities. Here, we've got that corrected, haven't we? We knew it was 101, well remembered, and we knew there was a check in the post that would bring that down by 26. And so that left us with 75. Well, that cross-references with the current account in the current liabilities, and so they are eliminated. Cash, we just add up the parent, we add the subsidiary, and in this case, because of the check in the post, we add that in as well, 146. Trade payables, just adding across the two companies that we're consolidating, and the current account within current liabilities has also been eliminated. So now you can see these figures all in the consolidated statement of financial position. We're really getting close to completion. Now, we need to find the post-acquisition movement on returns. We need to know what that difference is between the net assets at acquisition and the net assets at the reporting date. And this can be attributable to Lock since it was generated while Lock had shares in River. And in this case, it had all the shares in River. So looking at this, you can see that it's increased by 258. So the 258 is added in to the retained earnings, and we've also been able to add in the 24 for the post-acquisition share of retained earnings of Stream. So now we have a 602 retained earnings figure, which will go into our statement of financial position. And it's worth it for me just to draw Andrew's attention and everybody else who's listening's attention to the significance of this working, because this is where you earn quite a lot of your marks, when you're able to show where the retained earnings has come from. We talked about routine adding up and copying of numbers. The examiner doesn't reward you anything like as well for those kind of entries as they do when you work through your retained earnings. So retained earnings earns a lot of marks.
And this gives, if you go back, please, Sandy. So this gives very clearly, I think, the retained earnings of Lock, then what is it, of River, and also Stream, isn't it? And altogether, what does it mean? And of course, the what the pub is, and the impairment, all these items that we need to take out from the retained earnings.
It does, yes.
And I guess that's the reason why, the examiner clearly sees this, that the student is quite aware of these items, the workings and the logic behind it, and gives you high marks. And I think even from a CIMA point of view, you will get the questions, the MCQs on this.
Yes, they will specifically target a retained earnings calculation in a multiple choice question.
Thank you.
We can see where the 602 goes, because I've pointed it out here with my little arrow, that the 602 is going into the retained earnings in the statement of financial position, and we know where it's come from. We've had to do its own working. So now we've got to do some adding up, and you can imagine that you could be working against the clock, and you would no doubt tell me how little time I've got. But I think it's important to know that sometimes it isn't a good use of time to add them up, because there isn't an awful lot more marks to be got. I think from your point of view, from my point of view, it's useful to have completion. And so we've got here, I've added up the rows to give me the opportunity of working my way down, and I've got a profit for the year. So you can see here that we've got revenue added up across. I think this one's worth me just showing you. I've got 3 lines and 3 columns all adding up here. There could be as many as nine numbers to add up when I work out my cost of sales. But it is important, and it's well worth it to do it in this spacious way, because then it enables the examiner to see that you know what you're doing. Then gross profit is the takeaway sum. Similarly, we've got the expenses. I'd forgotten what the 20 was, but the 20 was the impairment of River, so that's been added to expenses. So we've got 214, deduct that from the gross profit, gives us the profit from operations. Then we take off the finance cost, add in the share of profits in associates, profit before tax, and then profit for the year. And similarly here, we've added together all the aspects that make up the non-current assets, then all the current assets. That gives us a total assets figure. We've added together all the areas of equity. There was no non-current liability because we had eliminated the intercompany loan, and that left us with trade payables of 733 and the accounts balance. And I said to you that I would show you how this is rewarded. So we've got our marking guide here. The first 3 marks refer to the little question, the one where we were dealing with the share premium account and the issue of new shares. But the remainder are the ones that make up the big question, which we've got above. You get 3 marks for calculating the goodwill. You've got 1.5 marks for your investment in associate, 2 marks for the intergroup activities, and 3.5 marks for your consolidated retained earnings. So they are really big mark earners, aren't they? Then you've got the 6 marks for the routine completion of the consolidated statements. And so in some respects, once you've started them and you've got your entries in those accounts, the fact that you've added up your total assets and you've added up your total equity and liabilities probably won't earn you any marks, because you've got the marks already within the information that you've given the examiner. Here are some of the common errors. The examiner said that the most common error was the calculation of percentage interest in the associate entity. Not one that you got wrong, but certainly at the time, that was one where I think it was a question that the candidates had muddled up and not recognised that one figure had got a dollar sign in front of it, and the other one was simply describing the number of shares. The fair value adjustment got missed. That was the 144 additional. And this is the kind of mistake that happens when a candidate is jumping about within the information. This very, almost boring, sequential approach of just taking each line and taking the information of each line and not missing anything makes sure that you don't miss things like the fair value adjustment. Including excess depreciation in the goodwill calculation, well, I think that probably just reveals lack of understanding. And then trying to calculate goodwill in the associated entity, well, no, because there wasn't the opportunity to do that because there wasn't information. And then using the cost of the associate as the investment in associate. Well, if you do that, your double entry bookkeeping will still balance. It's just that you've not recognised the 24,000 increase in the value of that investment because of the profit that the investment has earned during the period that we've held 30% of it. And then including the current accounts in the consolidated statement of financial instead of cancelling them out. Exactly. I think that shows the examiner a lack of understanding that a group is everything all together and you can't have inter-transactions. The check in transit in receivables instead of the current account. If I was to feel any sympathy, then that would probably be the one, because the examiner had been kind, but very often receivables would include the current account. Cost of sales not adjusted. Here we can see the value of our extra rows. We had those extra rows in our statement of profit or loss. That helps us do that. The expenses were not usually adjusted for the goodwill impairment. Well, this is a fundamental double entry point. Every time you take something from the additional notes, you're looking for a double entry. Not cancelling the intergroup loan and including the associate entity using acquisition accounting instead of equity accounting. Well, that's another error where you need to know that equity accounting is what you must do for an associate, whereas consolidation is only for subsidiaries. I haven't given you a lot of chance to get a word in edgeways there, so I suppose I was using a little bit of exam technique to really motor through some of that. Andrew, does that raise any questions with you?
Yeah, so one of the things I think what you've emphasized here is, again, applicable to anyone who's doing a full question, a big question like what Sandy had presented to us just now, or even in an MCQ situation, same things apply, right? So I think it's very important to understand what the common errors are, because that throws out the areas that you need to focus. Thank you, Sandy, for providing that.
Now, we've got a couple more slides. Just consolidation can go up further. Certainly, as you start to go through your studies, then you start to bring in mid-year acquisitions, and these are particularly significant within a statement of profit or loss, because you're looking, well, first of all, you need to establish whether the income and expenses have accrued evenly throughout the year, and if so, then you're looking at a 6 months or 4 months proportion of the total. We didn't have a lot to do with non-controlling interests, although we had an opportunity to talk about them. And certainly when examiners want to, they can have foreign currency translations. And this is generally a pretty exciting area of financial accounting, and it's well worth studying because it fits in with virtually every examining board's structure of exams. And although I've managed to put an extra R at the end of Explorer, I hope you accept my apologies for that, but we hope that this taster will give you the enthusiasm to want to explore it further. A big thank you to everybody for attending, and we hope to see you on the 15th for the investment appraisal. I'm slightly over. I think we were a few minutes late starting, so I don't think we're massively over the hour that we promised. But I hope there's none of you who are desperate to get to work or something else, like they're waiting for a train. Any final questions?
Right, so all the questions will be answered if you can put it in the chat box. I see some of you have said, I've got questions in a practical sense. Please do put it in the chat box. I will reach out to you individually. And my name is Angie D. Alves from Ultimate Access, and Sandy from Ultimate Access. And great to have you guys here. And you sat with us for 1 hour, went through this consolidated accounting, and we're going to have another session on the 15th of April. Please do join us if you enjoyed this session. I'm sure Sandy is going to have something really interesting for investment appraisal. Thank you, Sandy.
Thank you, Andrew, and thank you to everybody who's come along to today's session.
Thank you again. Bye-bye.